to the first episode of Finsec podcast. Today we will discuss decision taken by SEBI in its board meeting dated 19 December, which was yesterday. SEBI in its board meeting has discussed more than 19 or almost actually 19 topics, which have small and big announcements. But for the purposes of this podcast, we will cover the five key takeaways what SEBI decided yesterday. So for this podcast, we have Sandeep. Everybody knows Sandeep, needs no introduction. Sandeep Parekh is, of course, partner and founder of our firm, Finsec Law Advisors. He has been head of legal ED SEBI. He also sits on the board of STFC Bank. But for today's discussion, we will stick to the topic of the SEBI board meeting. My name is Anil Chaudhary. I'm also partner of Finsec Law, and I will lead the discussion. I will let Sandeep give the feedback. I'll introduce the topic and get Sandeep's feedback on what SEBI has done in this last board meeting. Thank you, Sandeep. Welcome for the podcast. This is our first podcast, so we'll be judged. So let's see. Let's start. So in the first topic that I want to talk about is the SME listing process. SEBI in its board meeting has actually come down hard on this SME listing process. They have increased the compliance requirements. The key compliance requirements they have increased is like now SME companies looking to raise capital from SME board have to file draft offer documents. Earlier there was no requirement. Now draft offer documents will be filed. It will be open for public to comment on those offer documents. There are restrictions on offer for sale that you cannot use only certain amount of money you can use for basically buying out the shareholders. And third is the use of proceeds. You cannot use proceeds for general corporate purposes more than 15%. And I think the one big change is that eligibility requirement. Earlier there was no profit criteria. Any Tom, Dick and Harry company, loss making or profit making, could have raised capital from SME listing process. Now SEBI is proposing that there has to be a profit requirement of at least 1 crore in previous two out of previous years before going for listing. So these are the broad changes they have done in light of the fact that only in 2024 there were 236 companies which raised money from SME. There was 8,600 crores have been raised, and I'm just curious to understand what forced SEBI to make these changes. We understand there are a couple of orders which people have questioned the use of proceeds of those IPOs, and therefore SEBI passed an interim order and stopped that IPO even before it went for fundraising. So just wanted to know your reaction on how do you feel about the changes in the SME listing process?
So thanks for initiating this podcast. I think it's a great idea, and you managed to kind of execute it in less than a week after we discussed it. So I think it's really, if you look at it from a conceptual basis, I think it's kind of a winner's regret that SEBI has. I think they opened the door to SMEs to enter the IPO market, and now they're regretting it. Really, they're saying that too many kind of so-called low-quality companies are coming in, doing RPTs, returning money to promoters, doing other forms of mischief, which we now want to curb. I think the only problem is it kind of is philosophically very jarring, because since 1988 we moved away from the merit system, where we looked at profits, we looked at the face of the person who's coming to raise capital, and then we said, okay, you can raise only 600 crores at so and so price. We kind of going a bit in that direction, where we're deciding who will raise capital, how much, for what purpose it's going to be raised. General corporate purpose, for instance, in this case, is restricted. So I think essentially the ideal form of raising capital, and again, you've written the book on primary markets in India, so you know this better. The ideal form of raising capital for the smallest kind of growth companies is really kind of the PEVC market, and not really the IPO market. So I can see where the regret is coming from, but I think if you ask me from a very purely jurisprudential perspective, I'm really not very happy with the changes, because it kind of changes the entire philosophy of going ahead with full disclosure, rather bringing in many elements of merit into the decision of how much you can raise, where you can raise, what you can use the money for, and stuff like that. So conceptually, I think it is a bit jarring.
So as a follow-up, I want to understand what prompted SEBI to come up with SME listing, because there was always a main board listing option open. You could have just followed the process and get it listed. And only thing we hear about ever since SME listing has started is amount of money raised, 8,600 crore, 236 companies. But there has been no impact analysis of actually what benefit the real economy has got from such SME listing, whether these companies have become more successful because of the fundraising, or rather they should actually gone to private equity market where private equity investors would have done due diligence and then invested the money. Here you are exposing them to retail guys spending 500,000 rupees and investing in companies where there's no diligence or just little diligence done. So just trying to understand where do you think if SEBI has gone wrong, should we just stop it and say that let's only do main board, or what's the way ahead?
So I think you hit the nail on the head. I think it's kind of had the problem of too much success, and too much success means too many people. Again, since it's a disclosure-based regime, people have said, okay, I only have two shops and eight employees, and those people have managed to pay thousands of crores. Of course, they didn't accept thousands of crores. But I think the whole idea of kind of a small shop raising capital from the IPO market itself kind of conceptually not right, and that's where this problem is really coming from. I think people have raised money based on full disclosure so far as we know, and like you said, there's no data to show the success either. So we really don't know whether that money has actually gone into buying that third shop in the first place. So it's a little difficult to kind of digest what really has happened in terms of the data, what needs to be done in terms of curbing mischief, because if there's mischief, you curb it with kind of enforcement action, not with these kind of merit-based systems. So it's kind of without data, it's very hard to judge what they're doing and what they should do really. But like I said before, it's a jurisprudentially jarring concept of introducing profits back. We got rid of it almost 25, 30 years back.
So thank you. I think one idea which I had was if you want SME, when you want smaller companies, you should have bigger capital chasing that smaller company. Why can't we make it institutions only platform? The first fundraising IPO should be done by institutions only, and after a year or two, then you expose it to public. Then now it can be listed automatically in public, and public can buy and sell. Institutions can offload in the public. That kind of middle path where somebody who's putting the money, which should be the
Yep.
institution, rather than exposing themselves directly to retail.
Makes sense. I think either that or just revert back to closing this market and kind of just go back to the regular PVC market once they mature enough and they're ready for the IPO market. After some scale, and again, it can be loss making. We've seen a lot of companies, all the your instant delivery services. They demand a lot of capital for expansion for a nationwide this thing. So I think those kind of businesses, even though they've been losing money for maybe a decade, they still may be worthwhile purchases. That's not to say that just because you made loss for 3-4 years, you're not really fit enough for the market.
I think they are regulating it the wrong way.
Wrong
This
way.
is
Exactly.
fair enough. In the interest of time, let's move to the next topic. Uh, Now, SEBI has also proposed amendments to merchant banking, which is a hotly debated topic. There have been past orders we've seen against large merchant bankers. Uh, but the essence of the whole regulatory push right now is vis-a-vis merchant banker activities, what they can do, what they cannot do. So SEBI has very clarified that there are permitted list of permitted activities that you can do, like underwriting, etc. There are only certain activities. And any other activity which is not securities market, you have to do. Now SEBI is saying that you have even valuation. Valuation is something merchant bankers are known to do. They say, no, you have to carry it to separate business, hive off, create a subsidiary, and then do it in that company. You can share resources, but the liability should be separate. You cannot liability. So I just want to understand where SEBI is coming from. Why do they now need to regulate merchant banking, which has been, from 1992 there have been regulations on that.
So I think again, I think this has a little bit of history, so it's good to kind of mention it here. Over the past year or so, SEBI has actually taken action against merchant bankers for not complying with the law. And exactly what the law was that they did not comply with is what was declared in yesterday's board meeting. So they said you cannot do kind of act as merchant bank in the listed unlisted space. Again, there's absolutely no prohibition. In fact, there's a specific regulation which permits them to do that. So they've taken enforcement action for stuff which is actually specifically permitted in the regulations, which is of course a little bit bizarre. But I think to justify that, I think they need to kind of come up with regulations that now we're going to draw the red line, and this is the new Lakshman Rekha. But I think it's they're dividing it into, I guess, 3 or 4 parts. One is you can only do what we tell you to do. You can do nothing else, even in the regulated space. Number two, if you want to do regulated stuff, then you have to kind of set up a separate company, or with some efficiencies of sharing resources, but no liability which escapes from there to our domain. And again, if it's regulated, but let's say regulated by RBI, then again it can be done within the same entity, but it can't really be. It has to be. I presume they'll say that it'll have to be a separate division. Um, and like I said, if it's not permitted, it's prohibited, kind of, which is again not something which we're very commonly used to. So they've essentially, I really don't know where it's coming from, because if they are looking at risk of capital, then they could have just simply said that if you're deploying capital, if you're guaranteeing anything, if you're kind of doing any NBFC like activity, these are the rules of the game. This is the amount of capital you can deploy for these activities, and it should be X times your net worth, or X times your liquid net worth, etc. Which is what they've done for underwriting, for instance. So it's not clear to me why they've done this in the first place, because I really don't see too much of a risk in terms of merchant bankers doing merchant banking for the unlisted space, and it's really going to cram the space itself, right? So unlisted companies which were using solid merchant bankers with a lot of experience will no longer be able to use the same merchant bankers, because it's unlikely these large merchant bankers are going to set up a separate company and provide the same services to the unlisted space. So
and also I think, see, if anybody who could do the space of merchant banking unlisted spaces, guys who have done listed spaces, I mean, from real value to the consumer, the customer that you're dealing with, the actual real economy impact that a company should raise capital easily and get the best services out of it. The merchant bankers are the right
yep.
people to do it. The SEBI is living in its own regulatory, cocoon, and think that this is the world. There's no world outside that. So, from the point of view of SEBI, I'm just trying to understand, why would you ask these guys that as long as my net worth is protected,
Yep.
I can take what liabilities I want, I can do what business I want. If there's a conflict of interest is protected, I can do what business I want. I can do valuation business. What's wrong for me to carry out valuation business? If there's a conflict of interest, I will disclose. If there is an issue where my net worth can be eroded, you put a cap on it. I save that capital is saved. And underwriting obligation, there are also net worth criteria. Check all what I can take. So all this is protected.
Yep.
So now, just to say that now ease of doing business is gone. Now, no ease of doing business. You create a new company. I don't care. Share resources. But now my tick the box has happened. This is the list of activities you do. Rest is not in my regulatory domain, so I don't care. You default fault, I don't care. So that is for them is protecting their turf and ensuring that if you are regulated with me, I'll ensure that you do only things that I can have a lens on. Rest I don't care about.
No, so I can sympathize with SEBI if they want to protect the company from liability of other activities. But again, there are ways around it, like you said. One is you specify stuff which you can do or which you can't do in terms of, you can say you don't do fund based activity, right? So it could have been a very narrow restriction imposed on the merchant bank, or you could have kind of regulated, said that okay, if you want to do unlisted space, this is the kind of net worth you need. Secondly, I think it will have a deleterious effect on corporate governance as well, because you have the largest and the biggest merchant bankers advising unlisted companies. Those standards would certainly be higher, which now they're unlikely to use, because they'll use the kind of more local merchant banks.
One more interesting topic that I want to have your feedback on the minimum revenues. Now SEBI is saying that if you are a category one, category means you can you can be a lead manager to an equity IPO, or then you have to have minimum earn 25 crores in 3 years. If you don't earn 25 crores, come back and give me your license, or I'll come to you and take your license back. And for category two, 5 crores, 3 years you have to make. What is this logic that I want to? One thing I can do is I can have to do business. So to do your business, if you're not carrying out a business for 3 years, then you give me your license back. I understand, but to earn minimum revenue of 25 crores, otherwise give me your license back.
I think it's clearly uncomparative. How does somebody start a business and create 25 crore revenue in 3 years? So it's I think it's I hope somebody challenges as an anti-comparative device, because I mean, who's going to guarantee 25 crores of revenue? And again, merchant banking is very famously very cyclical business. So yeah, except for the largest people, I guess not too many people are going to have 25 crore revenue in 3 years. So again, it really doesn't achieve anything at all. It will kind of, in addition, it will be anti-competitive, because it won't allow young and small players to kind of scale up from, whatever, 10 lakhs of revenue, 20, 30, etc. So either you kind of sponsored by really big people, or you kind of
Sponsored,
will
you have
take
to
away.
get money also. It's like I'm funded, but I don't get clients. What do I do? So I think that SEBI's push all throughout is to make it a big boys club.
Yeah.
If you see mutual fund, they increase the net worth. For everything, they're increasing the net worth and ensuring that the big boys only play. Small boys, I think, are risky business. So for entrepreneurship business, people that the already established class of merchant banker, the 5, 7, 10 we have, they should only be the people who, because we trust, we have a relationship with them. We cannot get the new guys who don't make
They look
money, and
kosher.
yeah, they look. So fair enough. I think we'll stop
No,
at that.
no, no. So just to kind of quick point on that as well, which of course I've argued more than a dozen times, is the whole concept of net worth has to be sensible. It can't be we want big people, therefore we'll put net worth. You don't put a net worth for lawyers. Why do you need a net worth for AMCs of mutual funds? Same thing with stock exchanges. They're technology platforms. They don't need a net worth. Clearing corporations, in fact, you maybe too little, but for exchanges, alternative exchanges can be run with 1 crore of capital. What do you do with the other 99 crore rupees? So I think this whole concept of net worth has to be relooked at, and again, I think SEBI has consistently thought that big players means kind of more controllable space, and therefore they see it as a shortcut to having a smaller garden to manage, really, so to speak.
Fair enough. Let's move to the next topic. I think the next one is the past risk and return verification agency. So one more line of business for people who want to register with SEBI and exchanges. So now SEBI has come up with this new agency which will verify and the risk return of investment advisors, research analysts, and algo trading firms. Let's say you say that in the past my strategy is XYZ, my strategy has earned 15% CAGR over 3 years. So that has to be verified by these agencies. Now these agencies will of course will have to be registered with exchanges, so they have of course put some capital in there. Also they'll put net worth, you have to put net worth. Otherwise you can't become an agent. So there then once you become these companies, of course they have to they will charge these entities, individuals, IAs, REs for giving this, and they will of course they will have own requirements. My basic question is that this whole validation is whether it's required or not. Why not self certification? We have mutual funds who regularly disclose NAVs.
Oh.
There are PMSs, AIFs whose NAVs are disclosed. Why this again treatment to small time boys? When the small time boys come to play a game, IAs, RAs, you make them difficult to run their businesses.
They're the smallest of the small.
Yeah, then they will ease of doing business is gone. You have to go through one agency who will look into your this thing, pay them money, that have time constraints, etc. So how do you respond to that as to where SEBI is heading us on this agency with?
No, so I think already people like investment advisors are very rare, just less than 1,000 people, and it's been around for nearly a decade now. And the reason is because you'd rather be a influencer and appear on YouTube rather than kind of be regulated. The costs are so high, the kind of inspections end up being kind of a big challenge for these small players, or often with shops of just 1 or 2 employees. So I think it's quite a bad idea in terms of just the cost and benefit, the cost benefit return. It'll impose a large cost, and will even those 900 odd people that we have as investment advisors are going to start thinning in further. Uh, I really see no reason why simple mathematical formula which anybody can generate on Excel, the CRAR or IRR, needs a special agency, which also I think they mentioned credit rating agency.
Yeah,
will do a, so really it's a shortcut to if somebody is doing mischief and putting wrong numbers out, uh, there are two very simple ways to do it. One is just say that this is the methodology, everybody should follow it, and take enforcement action in those rare cases instead of putting such a huge cost on the entire industry. And they seem to have not chosen that. I think that's the easy way out for them, is seems to be that put a cost on everybody instead of kind of enforce the law against those 2 3 people who kind of and again, the easiest way to have a particular standard, if people have differing ways of calculating, there are differing ways of calculating IRR, for instance, with some marginal difference. But put the standard out, say this is the only way we'll allow you to calculate, and put that out as a standard. And in fact, many standards are being developed with industry. So the Industry Standards Forum is in fact creating many standards. So I think this was actually such an easy, low cost way of just enabling people to use their Excel sheets and put out their past returns. Simple as that.
I think SEBI has this issue of not trusting people, that especially if when there are individuals involved and when there are people who have low net worth. So like mutual funds, why should performance validation agency also do mutual funds NAV evaluation? Every day they should go sit there and calculate. But of course that won't happen. It's practically not possible. Even for these guys, I think it was, as you said, easy to for do one in inspection, take all the records as to what how have you calculated your past returns, and they could have just taken follow take stringent action. No, you impose lakh and 2 lakh penalty after imposing all these orders and all. And when your enforcement is weak, to cover the enforcement, you pass on the buck to somebody else.
Yep.
That is what they've done in the performance validation agency. That you get some agency that agency will do. I am not responsible. Once they validate, I am okay. So I think that's why SEBI, I think, rather than trying to make the industry grow, they want to try to protect that no question should be asked to me.
I think the only good thing is the acronym is nice sounding. So I think that's one.
PRR, VFA, I don't know, PRRA. But I think SEBI has done better things than insider trading. That will be more interesting to you. I've written a book and all on this, the resident expert on insider trading. So on the insider trading bit, I wanted to know, now SEBI is saying main thing they've done is, I think we will understand Regulation 30 for the people who are watching it. SEBI has a disclosure regime under a regulation called LODR, Listing and Disclosure Requirements, wherein under Regulation 30, SEBI prescribes if these are the list of items. Once this kind of thing event happens, you have to mandatorily disclose. That is a disclosure requirement a listed company has to follow and give it disclosure to the exchanges. Let's say a promoter has been arrested or some action has been taken. Any kind of big item, big picture item, material event, some control transaction has happened, that has to be disclosed materially immediately within 30 days, 30 minutes or 1 day, whatever the case may be. So now SEBI is saying that there's a different regime called insider trading, which is UPSI, unpublished price sensitive information. And there is a definition under UPSI, what is price sensitive. There are a list of items like any kind of dividend declaration is deemed UPSI as a UPSI event. Now, SEBI is saying that anything which is under material event under Regulation 30 LODR will be deemed as UPSI under the insider trading. So what the effect would be for each of these events which are material, SEBI will, all these companies will have to create a structured digital database. They will have to ensure that each of the people who are aware of that information should be put on this thing. And the list of items is so big. I'll just give you some examples of the list of items. Like agreements by whatever name called impacting the management control, fundraising of proposals, fraud or any kind of allegation of fraud, and then action initiated or order
Even
passed.
Initiated itself is
action initiated. So I get a show cause notice, then everybody who's handling the show cause notice become UPSI and you cannot trade. Eventually, if the entire list is followed, what will actually happen is every second person in the listed company will be an STD. B, these guys can never trade. You should rather make a rule that no, if you are listed, if you are insider, if you are employee of a listed company, please don't trade in your company. Why follow insider trading laws and all this, all bullshit. Let's leave that, because half the time, half the year you cannot trade because only quarterly results, etc. Then there are all these SDDs have been framed. Then the point is SEBI, if point is that they have forgotten the difference between what is material price sensitive, material information which is disclosed to be exchanges, what is UPSI.
Yeah.
And that's where I think I want your insight as to why this should be different and why what SEBI is doing is not correct from a principle base of what is insider trading and what is disclosure requirement.
Yeah, so insider trading has, of course, two wings to it. One is the substantive thing which we are not discussing today, which is you have access to some material information, price sensitive information. You trade based on that without your shareholders knowing about it. Today we are only talking about what we call the corporate governance in insider trading, and this ends up being anyway quite burdensome because you have to create a structured database in which you need a timestamp which captures all kind of events, which till now were more narrowly drafted, but now it's going to be expanded hugely. Imagine every show cause for a large company or top 5 company would have on average received hundreds of show causes every year, whether it's tax, GST, SEBI,
Pollution,
RBI, whatever,
environment.
So environment. So I think to kind of put each one of those things into the structured database, ensure that the employees who are aware of that do not trade itself is going to be an almost like you instead of running the company, I think that's going to be the main
Good business
job
or compliance
of the company.
officer. They'll get
Yeah.
all listed companies will get more people, hire more people.
You'll need an army of people to kind of enforce this. And yeah, I mean it's again to capture the mischief of you kind of imposing such huge burdensome regulations on everybody. And again, it'll, like you said, it'll create windows where they can't trade at all. So large number of people, very large. Just imagine the number of people who receive show cause notices across, various taxes, employment laws. Um, you know, likely to run into hundreds, maybe thousands of people in a large company, and all of those cannot trade while the matter is pending. And we know how long it takes for these matters to run. It's on average 5 to 8 years for any of these matters to go from show cause notice to a stage of disclosure.
Actual impact may be 1 crore, 50,000 rupees, 1 lakh. But how
they've not set a standard. They've not said that unless it's GST payable of 5 or 1% of your revenue. They've not put any standard. So GST of 1 rupee seems to be covered, at least as of now.
But that's why I think the principle of UPSI now, as a student of insider trading laws, we practice insider trading laws. We understand that anything which may material impact the price of securities.
Correct.
It is not just because it's a disclosable event does not make it a price sensitive information. Now, if some small income tax notice of 1 lakh rupees of a 1,000 crore market cap company does not have any impact, so that cannot be treated as UPSI, and that is you are changing the jurisprudence.
Yep.
If you see NKSOD committee report which amended the insider trading regulation, they came back and said, okay, we will make a principle based law and we made notes to explain the law and so that people can follow the principle based law. Now we are going back to square one. We are saying that we'll list out all the items, who will make the subjective determination with the UPSI. It's very difficult for me to as SEBI to enforce this law. Let's put all the list of the items. So it's like ease of doing business or ease of regulating. What is this?
So it's not just that. I think it's very poorly designed for the simple reason it's not catching materiality. I can understand if you bring in concept of materiality from elsewhere, but it has to have an impact on the stock price. You are receiving that notice even for a reasonably large amount for GST non-payment is not material normally. It has to impact the price for it to be price sensitive information. And these are really, if you look at it, these are deemed material information. And that's where the trouble is, that these are non-material events, but SEBI has in its wisdom chosen that we'll put a label of material information to these, and therefore all kinds of consequences will flow from this artificial tagging. Let me put it very bluntly. There's an artificial tagging of non-material events as material.
I think the tagline for the podcast should be ease of regulating versus ease of doing business.
I think that's a good topic.
I think that's what it is. I will regulate easily. I don't care about how you do business. For me, it's easy to regulate. I'll just put on a list of items. I think fair enough.
So one more thing before we close, we should also mention, I think some regulation called PUSTA was. So again, at least the news reports claim that it was actually voted on and defeated in the SEBI board, which is actually a very, very very strange law which SEBI was trying to introduce, where they wanted to bring suspicious trades as outlawed, which is in law. I mean, any first year law student will tell you suspicion is kind of not the basis of charging somebody. I mean, it's maybe a basis of charging somebody. It's never a basis of finding somebody to be guilty. In fact, if you suspect somebody and there's nothing else, that's actually a kind of a means of acquitting that person, right? So it's a burden of proof which you have failed to kind of rise up to, and therefore a person is actually kind of not is almost like certified innocent if all you can do is find suspicion. So luckily, it seems it was put up to the board, but it was not. It did not go through. But again, we don't know. We'll know um, once we see the agenda, unless they redact the agenda, uh, which
Well, the
maybe
newspapers have reported that PUSTA was on this thing. They had come up with a consultation paper. It's not like SEBI has
it was not.
Yeah, so there is a. So basically, how I framed this whole PUSTA was like Daya kuch to gadbad hai. Once you Daya finds there's something gadbad, rest it. I don't care after that. You prove why you've not done something wrong. Then pass on the burden to again ease of regulation. You get easy enforcement orders.
You put everybody in jail, then you'll obviously get the
10 at least
actual
right
10 out of a million.
So that's how it is, I think. And that's the last topic for today's discussion is that AMC's alignment of interest. So as we know, AMC's employees are the most responsible citizens of this country who say that we will contribute 20% of our CTC money that we make and we will invest in our own schemes, not because I want to, but because we say so. And now apparently there have been some pushbacks because you can't put restriction on employees to say that where you should put money and minimum amount also you have to put 20% on the schemes you
and
manage.
Which schemes?
The schemes you manage. I think that is a little too much. It's like people run RBI, people run countries, people run a lot of companies also. There's no restriction. They have also responsibility. They're no responsible that if I'm selling this medicine, I should have the same medicine, then only I can sell the medicine. Medicine, people can die the wrong medicine. But this is AMC mutual fund investment. So from that point of view, SEBI actually has got some feedback from the, I think, from the public, although they have not done away with the law, they have some relaxed, some norms like reduction of minimum investment amount, reduction of frequency of disclosure, lesser lock-in period. But I just wanted to know your reaction as to where is SEBI heading us to with respect to this kind of.
No, so I think that was a rhetorical question, I guess, because I think it's a really bad idea because really, if you think of it, forcing an employee to buy your own product may mean you may need to put an exceedingly large amount in equity or exceedingly large amount in debt. All kinds of second order consequences which are actually which are in contravention of your own suitability requirements that you've imposed on intermediaries. So I think they should have scrapped it, but at least they've taken one step back, which is I can't really complain about that. But ideally, I don't think it's really a great idea to kind of create skin in the game. And again, we saw in the great financial crisis, the skin in the game doesn't really kind of protect the system at all. So it's all theoretical construct based on which they've introduced these.
No empirical analysis in this. No. So I think I'll stop there. I think before, as you said, something of nice about SEBI, at least they have reduced. So on that note, is there something that you can say as to where SEBI, if not in this board, where SEBI is doing good as to we have like always attacked in all the 5 districts. So I want to be nice to SEBI before we pass.
I think the market infrastructure design, I think they've done really well. Not part of this board meeting, of course, but the whole speeding of the settlement. They're experimenting with T+0. We may think it's not such a big deal, but it actually brings in so much of float into the system. Today if I sell something, tomorrow by afternoon I have the money in my bank, which is
secure also, that money
and
doesn't
safety.
go away,
Because less money is floating around, much safer. So I think if you look at market kind of design, I think they've really got it not just well, but I think we're way ahead of the rest of the world.
I think the Karvi, I think that even the chairperson said after my like dead body, anything go like that.
Something like
I
that.
think so. I think that way, I think they have been very nice on the market brokers whole ecosystem of protecting the retail guys from any kind of issues with the broker. I think we'll stop at that. I think thank you very much for your time. And
Thank you.
We'll meet at the next podcast.